The world's top investment giants, BlackRock, PIMCO, and Bridgewater, are collectively repositioning their portfolios to guard against a potential resurgence of inflation. Driven by rising commodity prices, the AI infrastructure boom, and potential political pressure on the Fed, a key market gauge, the 10-year inflation swap, has posted its biggest rise in a year. Some leading institutions are even warning that inflation could climb back above 4% by year-end. This puts Fed Chair nominee Kevin Warsh in a potential bind, caught between President Trump's heavy pressure to cut rates and the looming threat of rising prices. While most global investors remain complacent about cooling inflation, Wall Street's smart money is quietly building defenses. According to a February 2nd Bloomberg report, BlackRock, Bridgewater, and PIMCO are actively adjusting their portfolios for price pressures that could come back stronger than expected. This stands in stark contrast to the prevailing market narrative of inflation steadily gliding back to central bank targets. Ben Pearson, a senior trader at UBS, put it bluntly: a U.S.-led inflationary boom is among the biggest risks investors are underpricing this year. He warns that if this scenario materializes, the Fed would be completely out of the game in the first half, forcing markets to reprice rate hike expectations in the second half. Facing these inflation worries, the three giants are taking different hedges. BlackRock has been adding to short positions in U.S. and U.K. government bonds since late last year, guarding against fading rate cut hopes. PIMCO favors the cushion of Treasury inflation-protected securities, TIPS, seeing them as cheap insurance. Bridgewater prefers equities over bonds, arguing that the massive near-term demand from AI infrastructure will create a challenging environment for fixed income. Market anxiety also centers on Fed Chair nominee Kevin Warsh. Investors are weighing his long-held reputation as an inflation hawk against whether he'll bend to political pressure and deliver the deep cuts Trump wants. Peter Orszag, CEO of Lazard, predicts U.S. inflation climbing back above 4% by year-end isn't just possible, it's the most likely scenario. Stephen Barrow, head of G10 strategy at Standard Bank, adds that if the White House's desire for cuts is derailed by resurgent inflation, the 10-year Treasury yield could rebound from around 4.25% today toward 5%. The global inflation picture is also getting messier. Traders in Australia are now betting the central bank could hike rates at its Tuesday meeting as domestic prices re-accelerate. In the UK, strong data has slashed rate cut expectations. Even in the chronically low inflation Eurozone, long-term inflation expectations are creeping up in tandem with stronger U.S. readings. As Bloomberg macro strategist Simon White puts it, with inflationary pressures building from all sides, Warsh faces a tough task whether he opts to defend rate cuts or pivots to resist them. Doing nothing is no longer a long-term option. For everyday investors, the lesson is clear. Don't blindly follow the crowd expecting steady rate cuts. Be wary of the volatility that resurgent inflation could bring. Take a page from the giant's playbook. Consider a modest allocation to inflation-protected assets, manage leverage, and avoid betting the farm on rates moving in just one direction, down. Stay glued to Fed policy signals, U.S. inflation data, and Warsh's pronouncements. No panic buying or selling. The collective defensive shift by these top firms is a signal in itself. The market's core conflict now is the tug-of-war between inflation pressures and rate cut hopes. In this complex environment, staying cautious, observant, and flexible with your portfolio is the rational move. After all, with inflation's shadow still looming and policy paths unclear, respecting the market and managing risk is far more important than chasing short-term gains.